Let us see another problem on consolidation of financial statements, and in this case what is happening is that you are given certain revalued numbers in respect of assets of the holding company and the subsidiary company. So revaluation of fixed assets, okay, balance sheet as on 31st March 2012 of LIM Limited and Fung Limited are given, right? You have plant and machinery, investments, current assets, creditors, profit and loss account, and equity shares, right? So these are given in respect of both these companies. And you are told that the respective values of plant and machinery of LIM and Fung as on 31st March 2012 are as under: 230,000, 1,50,000, right? Prepare consolidated balance sheet as on 31/3/2012. Now you must be wondering that, what do we do with these revaluations? Let us think of a situation devoid of this particular case. Okay, let's say for example you had any company who does a revaluation of its asset. Do we consider such revaluation when we prepare the balance sheets? The answer is no. We do not consider the revaluation of these companies, right? So then, if we do not consider these revaluation, insofar as the holding company is concerned or the subsidiary company is concerned, in their standalone financial statements, there is no revaluation which is done, right? But when you prepare the consolidated financial statement, one of the things that we calculate here is goodwill or capital reserve. Now if you recall, what is goodwill? Goodwill is, let's say for example you make an investment, okay, of 100 rupees and you get something worth rupees 80, then we say that the difference which is there is paid on account of goodwill, right? But if someone were to come and say that, hey, hold on for a minute, this asset is not worth rupees 80, it is actually 120. Why? Because the books show a value which was accounted for a long period ago. So let's say suppose you have a value of land or you have building which was purchased 10 years ago. In the books it might be coming at 10 rupees, but the real worth may be 50. Right? In that case, what is happening is, it is not that I am paying more to the company and getting less. No. What I am getting is actually more than what I have paid for. Why? Because the market value of this thing is more than the book value. To take care of such situation, the revaluation amount which are there in respect of these assets are considered, but only for the purpose of consolidated financial statement. And because goodwill and capital reserve is computed only in respect of the subsidiary, right, we do not consider any revaluation insofar as the holding company is concerned, right? The reason why we do these revaluation into account is because that impacts our goodwill or capital reserve, right? So with this logic in mind, now let us see how will we deal with the case of revaluation. So you are given the revaluation of both the holding company, right, and the subsidiary company. As I told you, the revaluation of holding company is useless because you don't revalue this in the standalone financial statement and you don't revalue that in the consolidated financial statement. So this has to be ignored at all times, right? Insofar as the subsidiary is concerned, which is this company, right, we need to consider this revaluation for the purpose of calculating my goodwill or capital reserve. So let's start preparing the balance sheet. CBS. I'm not writing all the details and everything again and again. Okay. So you have assets, non-current assets. In this you have fixed asset, right? So Lung is 170, Fung is 110. Right? We will consider the revaluation later on and also consider the depreciation on such revaluation. I'll come back to the reasoning and the logic for this. Then you have investments in 70% of shares of Fung Limited as on 31st March 2012. Now incidentally in this question, the date of acquisition and the date of balance sheet is same. Right? So let's say for example, we were drawing this timeline, right? My balance sheet date, which is 31/3/2012, is also the date of acquisition, something which I used to mark by a red line, which means that all the profits which are shown in the balance sheet are capital profits. So there are no profits after the date of acquisition because the numbers which we are given are actually on the date of acquisition itself. But my investment is going to go and sit in the cost of control. Investment 1 lakh. Then current asset 180 and 185. So you have current assets 180 and 185 makes it 365. I'm just writing the total here to save some time for you. Creditors 150 and 90, 240. Current liabilities, trade payable. This is 150 plus 90, 2,40,000. Share capital, equity and liabilities, shareholder funds, equity share capital, 2 lakh. 1 lakh for the subsidiary company, this goes less. Equity share capital, 70% we are owning, so we reduce 70% from here. Minority interest, equity share capital, 30,000. Right? Profit and loss account, 1 lakh, 1,05,000. Profit and loss account, 1 lakh. The entire profit is a capital profit. Why? Because my date of acquisition and the date of balance sheet is the same. So I don't need to necessarily prepare an AOP out here. 1,05,000. So share of profit. So 1,05,000 is the total profit, out of which we own 70%. Right? So 70% of 1,05,000. This will give you 73,500. Right? Let's just recheck it. 105,000 into 0.7. This is 73,500. Right? Minus 105,123, 31,500. So 31,500 belongs to the minority. Right? Now, the only thing left out here is that the revaluation for Fung Limited has to be done for the fixed asset. So in the balance sheet, you have 1,10,000 worth of plant and machinery, right? Whereas you have 150 here. So how much is the revaluation? The revaluation is equal to 1,50,000 minus 110, 40,000. For the purpose of preparation of your CFS, you have a revaluation of 40,000, right? So revaluation, when you do, what is the entry that you pass? You debit your fixed asset because their values are going up, 40,000. 2. So what will be the amount which will be credited? This is actually going to go to the profit and loss account, and because in our case the entire profit is capital profit in nature, so what we will do is we will add on the relevant portion to cost of control and minority. So minority gets 30% of this, cost of control gets 30% of this, revaluation of fixed asset, right? Are we done? Yes. Normally you would also charge depreciation on this amount, but in this case what is happening is that the revaluation date and the balance sheet date are same. So obviously there is no further depreciation. But if in such a case, let's say for example this revaluation was done on 1/4/2011, then in that case you would have charged depreciation for 1 year on the revaluation amount, which is 40,000. So let's say you were told that the depreciation has to be at 10%, you would charge 10% of 40,000 as depreciation. But in this case it's not there, so we're just leaving this. So let's do a total of this. This gives you 73,500 minority interest, right? This will give you 511, 1 carry, 15 into 17, 171,500 or 71,500 of capital reserve, right? So you have capital reserve of 71,500, you have minority interest of 73,500, right? Revaluation we've done here for 40,000, there is no depreciation, so what do we get? 280, 320, right? Do the total, 685 is what we get here. And on this side also, let's see what's the total that we get. 000, 1, 4, 1, 5, 4, 7, 11, 7, 18, 1, 2, 3, 4 and 2, 6, right? So the only impact of revaluation is twofold. Let's just summarize. The revaluation can be done by the holding company or the subsidiary company. In the standalone financial statement, we know we do not do any revaluation here or any evaluation here. When we prepare the consolidated financial statement, the holding company will not do any kind of revaluation, right? But the subsidiary company will have to account for the revaluation for the reason that we need to compute our cost of control, which basically is nothing but a comparison of what we pay less what we receive. If the market value of the plant and machinery is higher, then what we receive is more. Therefore, we need to reduce that market value from here, and therefore, whatever revaluation is done in respect of subsidiary, that is considered. If the date of revaluation is before the date of balance sheet, revaluation date before balance sheet date, then we need to charge depreciation or additional depreciation on such revaluation, right? We'll see many more questions around revaluation, but yes, they're going to be only part of the complete question. So thank you for being with us today. You can visit our website www.irdbook.com for many more videos on CA final accounts, which are equally applicable to the students of CS, ICWA or any course that you are doing which contains these topics.